So influencers can end up owing a lot in taxes, and I mean a lot in taxes, okay? I've got friends that personally pay the IRS enough to buy a brand new Tesla every single quarter, and some that pay substantially more than that. And in the grand scheme of things, I mean, this isn't the worst problem to have. You know, if you're paying a lot in taxes, it likely means that you're making a significant amount of money and hopefully keeping a significant amount of money as well. But regardless of your politics and views on taxes, most of us don't want to be paying too much in taxes. We want to be paying as much as we should be, but no more. So in this video, I'm going to show you the top 10 tax deductions that you can potentially take advantage of if you are an online influencer looking to potentially reduce your tax bill. Now, while these might not all apply to you personally, you might find one or two gems in here that could potentially save you thousands of dollars. So definitely stay tuned. And if you're looking to learn more about taxes as a self-employed person, I've got a full video that you can check out up here where I go through exactly how taxes work if you are self-employed. So definitely check that out. And let's dive right into the video. So when it comes to being an influencer, we have significantly more tax advantages than your average employee. And that's because the government wants to incentivize us to start businesses, okay? Because when we start businesses, we stimulate the economy, we hire people, we create jobs. And so it just helps make the world go round, kind of greases the gears of the economy, if you will. So the government is trying to incentivize us to do that, and that's why they're encouraging us to make certain purchases so that we can get certain deductions, which we're going to be covering right now. So these are some of the most commonly overlooked tax deductions for influencers. And just a quick little disclaimer here, I am not your tax advisor. This does not apply to you personally, nor is this tax advice. So please do not sue me. I am merely providing you information on some of the most common tax deductions that you could be taking advantage of. So without further ado, let's dive right into number one. Now, the first tax deduction you are probably not taking advantage of is renting out your house to your business. So like I said, definitely talk with a tax professional before you try any of these, but especially this one, okay? Because this one, it comes about because there is a little known rule in the IRS tax code, in the Internal Revenue Code, that not a lot of tax advisors even know about. And so the rule reads something like this. There's a special rule if you use a dwelling unit as a residence and rent it for fewer than 15 days. In this case, don't report any of the rental income. So you heard that right. If you are renting out your primary residence for 14 days or fewer in a year, you are not legally required. In fact, the IRS says you do not have to report that income to us. So this is a great thing because you can rent out your house for 14 days, pay absolutely no taxes on the income you receive. Wonderful. So some of you might be thinking like, great, I'll set up an Airbnb for 14 days. You're not thinking big enough, okay? Because what you could potentially do is rent out your house to your business, okay? So the person or entity renting your house, if it's for business purposes, they're gonna get a tax deduction, okay? Because if you were to rent a studio space to record a video, you could get a tax deduction for that because you're making a video that's related to your business. So there you go, tax deduction. But now let's look at if your business was to rent your house from you for say you needed a place for a business meeting, or you needed a studio space, or you needed a place to record a video. Any of those things could potentially qualify as a reason that your business would need to rent your house from you for this event. And so you could potentially receive that income, your business could potentially get a write-off, and you could potentially be one happy camper. Now, like I said, definitely talk to a professional before you try that because that is a bit more advanced. You're gonna have to go through a bit more hoops to make that one work for you, but that is deduction number one. Now, deduction number two that a lot of self-employed people are not taking advantage of, especially influencers, is their self-employment taxes. So if you didn't know this, I'm sorry to be the bearer of bad news, but you do have to pay self-employment taxes as an online influencer. And you will actually also pay these when you're working a job, but when you're working a job, they are called Social Security taxes, Medicare taxes, or payroll taxes, and they're automatically deducted from your paycheck. If you're an online influencer, that is not the case. These are coming straight out of your pocket and nobody is withholding money for you on these. You're also paying twice as much as you would if you were an employee, because when you're an employee, what happens is your employer pays half of your payroll taxes, you pay the other half. As a self-employed person, you have the pleasure of working for yourself, so you are both the employer and the employee, which means you get to pay both halves of that self-employment tax. But the key thing here is you get to deduct the employer half of that tax. So it's 7.65% each. So you're each paying 7.65. You add that together, you get 15.3%. The half that is designated as the employer half, that is actually deductible for your income taxes. So make sure you do not neglect that when you are filing your taxes, because this can potentially be a significant chunk of change. Okay, Mr. Beast made a whole video about how much Mr. Beast pays in taxes. One of the biggest taxes that Mr. Beast pays is self-employment taxes. And so when he's able to deduct that half of his self-employment taxes, that's a huge, huge tax savings that Mr. Beast is going to have, and that you could potentially have as well. Probably not on that big of a scale as Mr. Beast does, but you could still take advantage of that if you are an online influencer. Now, the third deduction that influencers can take advantage of is their phone and their phone bill. So as influencers, we are hard pressed to get by without our personal cell phones. They allow us to film content, to do emails, do all of this stuff that we need to do as a business owner. However, the IRS also recognizes that, and they allow us to get a deduction for the use of our phone and for our phone bill. But there are some stipulations here that you're going to have to keep in mind. Now, this comes straight off of the IRS's website, straight out of the Internal Revenue Code. So let me read that for you right now. So according to the IRS, you are not allowed to deduct the cost of basic local telephone service or any of the costs associated with personal telephone use. However, any charges for business long-distance phone calls or the cost of specific work phones are deductible. Okay, so what this means in English is that you cannot deduct your personal cell phone use. So if you've got a personal cell phone, you don't use it for business at all, it's just strictly personal use, there is no deduction associated with that. Same thing with your phone bill. Okay, if your phone bill is for a phone that's totally personal use, no deductions. But if on the other hand, your phone was 100% business use and your phone bill was for that phone that was 100% business use, that is in fact deductible. So what I have done this year in 2021 is I have a separate phone right here. This is my business phone. I now have two phones. I got a business phone and a work phone. And so this is my business phone. Was inspired for this by Nate O'Brien. He is a good friend of mine who told me about the joys of having two phones. And so I am now trying that out myself. But I've got this second business phone that is solely used for business, no personal use. And so now I'm able to deduct those expenses because I now have that business phone. Now, you don't have to have a specific business phone to deduct any of your business use from your personal phone, but it just makes things easier if you can split it up between the two. Now, so far, the two phone situation, it's working out pretty well, to be honest with you. I mean, I only started at the beginning of 2021, so we've got a little bit more time to play it out, see how it goes. But for now, I'm really enjoying the situation. It makes things a lot easier, a lot more streamlined. I can really put work away if I want to, or put personal stuff away while I'm at work, and it just makes things a lot easier for me. So something to consider if you're looking for additional tax deductions. Now, the next tax deduction is a little bit more complicated, and it's called the qualified business income deduction. And what we're looking at here is a tax deduction that was established in 2017. One of the more confusing tax deductions out there, like I said. I've got a full dedicated video coming soon on this one, so definitely stay tuned for that. But in the meantime, here's a little synopsis of how the qualified business income deduction actually works. So what we've got here is if your business is legally structured as a pass-through entity, okay? And essentially this means if you have a sole proprietorship, a partnership, or an S corporation structure, then you are treated as a pass-through entity for tax purposes. Don't have to worry too much about what that means for right now, but just know if you're one of those three, you are a pass-through entity. If you are a pass-through entity, you've got the potential for a 28% tax deduction on your federal income taxes as a result of qualified business income deduction. So what this means is, say you make $100,000 profit for your business, you could potentially take a $20,000 deduction on your taxes if you meet the qualifications for the qualified business income deduction. Like I said, a couple hoops to jump through on this one in terms of if you're qualified and if so, for how much. Depends a lot on the type of business you are actually running and how much income you made. So definitely stay tuned for that dedicated video. But in the meantime, just know it's a really solid deduction that you could ask your tax planner about if you are not aware of it and if you don't know if you're actually taking advantage of it at the moment. So moving on to the next deduction, this one is business travel. So a lot of people know that there is the ability to deduct your travel expenses for business, but not a lot of people know how this deduction actually works. And there are some stipulations you have to make sure you follow in order to potentially receive a deduction for your business travel. So if you're traveling for some kind of collaboration or a vlog or any other business related trip, you have the potential to deduct that on your taxes provided you meet the following criteria. And when I say you can deduct the trip, I'm talking things like travel costs, so your plane tickets, your Ubers, etc., your lodging, so the Airbnb that you stay at, and even other travel expenses like meals along the way and meals while you are actually at your destination. Now, what are the rules associated with this deduction? Well, there's actually only 4 rules. They're very, very simple. So once you know these rules, you'll be able to know, okay, can I deduct this particular expense? Yes or no. You'll have a pretty good idea. Again, probably still a good idea to talk to a specialist on this one, but here are the 4 rules that you're going to want to watch out for. First of which is you have to get outside of your tax home. This is a definition that the IRS establishes, but just know, you got to get outside your tax home. That's number 1. So you have to actually go outside the place where you live, the city where you live, and go somewhere else. pretty straightforward. If you're going on business travel, you should probably actually be traveling. So that's number one. Number two is you have to be there for at least one night. So you can't just go do a little day trip and call that a business trip. You actually have to travel somewhere, stay there overnight, and then it can be considered a business trip. The next thing is it has to be a majority business trip. Okay, so it can't just be you go on a business trip for a week and in the middle of the trip, you have one day where you have one meeting. Okay, that doesn't count as a trip. If you have 6 days of personal time, 1 day of business time, not going to cut it. Okay, the IRS wants to see at least more than half the time has to be business time, and you can still interweave some personal time, but it has to be majority business. Okay, so we're not looking at just like 1 day business, 6 days personal. We're looking at least 4 days business for 3 days personal. The last thing you have to keep in mind is that this trip has to be planned in advance. Okay, this cannot just be a spur of the moment thing where you just hop on a plane and go somewhere and then film a TikTok while you're at the airport and call that a business trip. Okay, it does not work that way. You have to actually plan this thing out in advance. How far in advance? That's a little up for interpretation, but it has to be planned in advance. So those are the 4 key things you got to keep in mind when you're talking about a business trip and if it can be considered deductible or not. Now, this only applies for business trips within the United States. So if you leave the United States, the rules are even stricter in terms of what can be defined as business or not, because it costs a lot more to go abroad. The IRS wants to make sure you're not just taking a trip to Italy and doing a write-off there, that you're actually going there for business purposes. So if you're doing international, it's going to be even more stringent, but if you're domestic, those are the rules that you have to watch out for. Now, the next deduction to keep in mind, this one is a huge one. I think a lot of influencers are not taking advantage of, and that is the home office deduction. So as you can see right here, we are at a home office. Okay, this is my buddy's home office, not my home office, but because he has this home office here, he is able to deduct a significant portion of his expenses thanks to this office. And if you are working from home, if you have an office or a studio at your home, this is potentially a huge place to find a significant tax deduction. Let's talk about how that actually works right now. So this one is also a little bit more complicated than your average tax deduction. So I will have a whole video coming soon solely on the home office deduction, because this is a huge one. I mean, like I said, guys, this is so important. If you have a studio in your home, if you have a place where you solely work, that's the potential for some serious tax savings if you know how this deduction actually works. So a brief overview for you right here, right now. 1, you need to have a dedicated space in your home. Like I said, you got to have this dedicated space where you're only working. This room is not used for anything except for work, and that is a requirement if you want to call something a home office. You can't have a mixed use space where you have a TV and sometimes it's a living room and sometimes it's an office. Does not work. It has to be a dedicated office space. Now, what you can then do is calculate the percentage of your home that is occupied by that dedicated space. So say, for example, this office right here was 10% of my buddy's home. In that case, he could potentially deduct 10% of things like rent, of his utilities, of his property taxes, of all of these expenses that go into owning a home. He could deduct those because 10% of that home is used for business, while the other 90% is personal use. So as you can see, if you've got a pretty significantly expensive home and you've got a pretty significant space in there that's dedicated towards business, this could be a serious tax savings for you if you're able to take advantage of this particular deduction. Now, the next deduction up to bat, this one is one of my personal favorites, and that is the retirement plan contribution deduction. So I'm a big retirement plan guy myself. I've got my own retirement plan for my business. I've got a personal retirement plan. I've got retirement plans left and right. Okay, I'm a huge retirement plan guy. And one of the reasons why business retirement plans are so attractive is because you get a deduction essentially for paying yourself. Okay, you're putting money into this retirement plan for yourself and you're getting a deduction for that. Okay, so for me, it's like a no-brainer. It's like I'm getting money to pay myself. Why would I not do that? So I personally max out my retirement plans every single year because I want to get that full tax deduction that is available to me from the IRS. So how does this work? Okay, well, you're able to deduct your contributions to that retirement plan, and then your earnings are able to grow tax-free. Now, this totally depends on what type of retirement plan you decide to pursue. The 2 most popular kinds of which for self-employed people or influencers are your SEP IRA and your solo 401k. These are the 2 most common types. I'll have a video coming soon kind of breaking down the differences between the 2, but just know that the SEP IRA, that's what I'm using right now. It's a lot easier to get set up. And if you're making less money, then it typically makes sense to get started with a SEP IRA because you can set these things up for free. I've got mine with Fidelity. They allow you to set one up for absolutely for free. I think Vanguard does the same where you can get a free one set up. So for me, it makes sense to start there. This year, I'm actually going to transition into a solo 401k. So I'll make a video soon about why that actually is. But depending on where you're at in your business career, how much you're planning to put into this account, it'll kind of vary which one makes the most sense for you. But in general, SEP IRA, a lot easier to get set up, a lot cheaper to get set up. Solo 401k, a bit more of a process there, but you can eventually put more money into that account in most cases, which is why some people would choose to go down that route. All right, I think this is deduction number 8 at this point. We are absolutely cruising, and that is your credit card interest and fees. So I'm a huge fan of credit cards, okay? If you've seen any videos on my channel, you know that I'm a big proponent of credit cards. I've got plenty of them myself, but I'm not a fan of paying interest on credit cards, okay? That is something that I'm a big no-go on. I can really agree with Dave Ramsey that credit card interest is big thumbs down, but I do not agree with him that credit cards are just evil and the devil. I think you can get a lot of value out of them if you can spend on them responsibly. Now, we're talking credit cards for business use here because you cannot deduct the personal interest on your personal credit card. Can't do that, okay? Cannot deduct the annual fees for your personal credit cards. Can't do that. But what you can potentially deduct is the interest and annual fees on a business credit card. And when I say business credit card, I mean a credit card that was issued for your business specifically. So I have about 5 credit cards for my different businesses, and I've got maybe 10 credit cards for my personal stuff, okay? The personal stuff, absolutely not deductible under any circumstances. The business stuff is potentially deductible, but you have to meet some criteria here. So the first of which is that a business credit card. Okay, great. We already established that. Second of which is that you're only putting business spending on this card. Okay, you can't get a business credit card and then go to Applebee's and buy yourself dinner and it's not a business dinner and call that a business credit card. Okay, you can't do that. You're mixing business and personal. It's a no-go. If you do that, you cannot deduct the annual fee nor the interest on that credit card because you have mixed your spending. That's a no-go. You cannot do that. Do not do that. What you need to do, you got to keep these things separate, okay? You got to have a business credit card where you put business expenses, a personal credit card where you get personal expenses, and you don't mix the two because if you mix the two, then there is no potential for deductions there. But if you're able to separate those, that's where the potential for deductions comes into play with the interest and fees on your business credit cards. All right, now rolling into number 9, deduction number 9 for influencers is your business expenses. So this is a pretty generic kind of catch-all term for all the rest of the business expenses that do not fit in any other category. What we're looking at here are things like your ring light, your camera, your microphone, really just anything that your business needs to function if you're an influencer. So the equipment that goes into your setup, the camera, the lights, the microphone, all that stuff is going to fall into this category of business expenses. Now, according to the IRS, for a business expense to be deductible, you got to meet 2 criteria, okay? It's got to be ordinary, it's got to be necessary. So if it's ordinary and necessary, then you could potentially deduct it on your taxes. If it's not ordinary nor necessary, then it's a no-go. And as you can tell, those are some pretty broad terms, like ordinary and necessary. How are you going to define that? It's not really a clean-cut box, And so you really have to think about, okay, if I'm going to buy this thing for my business and call it a business expense, if I was to get audited by the IRS, and I got talking to their agent right now, and they say, hey, you bought this, why was this ordinary? Why was this necessary? Okay, you got to make that case. Okay, so could you theoretically make that case to the IRS that this thing that you're buying is both ordinary and necessary? If you've got a case there, then maybe you can deduct it. If you don't have a case at all, probably don't try to deduct it because if you got audited, then that would probably not go through. Would be a bad situation for you. So make sure that you're able to follow that ordinary and necessary criteria. And in general with this one, it's probably best to talk to a tax specialist that works specifically with influencers because they're going to know the things that the IRS is like thumbs up and thumbs down. And there's a lot of things that you wouldn't necessarily think of when it comes to expenses for influencers that you can actually deduct. So make sure that you talk to a specialist for this one and for all of them, honestly, because you shouldn't just listen to someone on YouTube that is giving you tax deductions. You should really take your time, talk to a professional, and make sure you're doing this stuff right. So lastly, we've got deduction number 10 here. This one is, it's a little bit controversial, okay? I'm going to say that. And that is eliminating your state income taxes by moving to an income tax-free state. So a lot of you guys might have heard about all the people leaving California, leaving New York. There's kind of a mass exodus from these high income tax states to these low or zero income tax states. And I can totally see where they're coming from because I'm in New York right now. The state income tax here depends on how much you make, can range upwards of 8%, I believe. Okay, so we're getting close to 10% in state income taxes. That's on top of your federal income taxes. And it's on top of your self-employment taxes. So for example, say I was in the top tax bracket making 37% in federal income taxes, plus my New York State income tax, which say it's 8 or 9%, so we'll say it's 8% to bring us to 45%. Then we're paying our Social Security self-employment taxes. That brings us over 60% in taxes, folks. So with that, you can see why some people might be tempted to cut off that 10% tax that they're paying to their state if they can move to a state and pay 0% state income taxes. And so that's what a lot of people are doing. But how does this actually work? Okay, how does the process actually work for moving to one of these states? Well, let me give you a quick example here, okay? So say you were paying $50,000 per year in state income taxes. So say you're living in New York, for example, let's say you're making $500K, you're paying 10% to the state of New York, so you're paying $50K to New York every single year just to be a resident of New York State. Well, what a lot of people are thinking is like, well, what if I instead took that $50,000 and bought a place in Austin, Texas, or Miami, Florida, or like some of these other places where there's no state income taxes. And potentially what you're getting in that situation is a free place in Florida or a free place in Texas because you're paying, say you're paying $3,000 a month for a nice apartment in Florida, okay? $3,000 a month, nice apartment in Miami, that's $36,000 per year. So you're paying that much. You would have been paying $50K to live in New York. So essentially you're getting paid $14,000 in order to move to Miami and buy a $3,000 apartment, okay? And that's in addition. So you keep your New York house, you buy this Miami house, and you're profiting $14,000. So like when the math looks like that, I mean, it's kind of a no-brainer for a lot of people to do this. And so like I mentioned, you can actually keep your New York place and actually move to Miami. And that's because you only need to establish your residency in Florida in order to avoid paying that New York state income tax. And it depends from state to state what's actually going to qualify you as a resident of the state. But in general, what you're going to want to do is spend at least 183 days in that state. That's just enough to put you over that 50% mark of 1 year. And then beyond that, you're probably going to want to do things like get a driver's license there if possible, get new license plates, get a voter registration card, to do all the things that really a person who was living there would do because you're actually living there now. So you'd want to do all that stuff so that you can show the IRS, hey, I actually live in Florida now. I don't live in New York, but you can still keep your New York place. You can still spend a little under half the year in New York, and then you can also live in Florida. Now, in a lot of cases, there is a bit more that goes into it than just that, but it's something to think about if you're really getting up there in terms of income and want to cut back on these state income taxes that you're paying, is to potentially establish residency in a low or zero income tax state. So while these are only some of the tax deductions available to influencers, I think they should help you keep an eye out for things that could potentially be deductible down the road, whether they fall into these categories or not. And so as your business income goes up, obviously so does your tax bill, and it becomes more and more of a productive use of your time to find ways to optimize your taxes. So whether you like that or not, I mean, once you start making serious money and you're paying hundreds of thousands of dollars to the federal government every single year, it kind of makes sense to spend more and more time thinking about, okay, how can I cut down on those tax bills? Because one deduction could potentially save you 10, 20 grand in taxes. Like that's a very productive use of your time to find that particular deduction. So as time goes on, as your income goes up, it becomes more and more worthwhile to talk to professionals here who can actually help you, who have seen these things time and time again. These different scenarios come up and they know about things like moving to different states. They know about things like your home office deduction, things like that. So make sure you talk to a professional, especially once your income starts getting up there, because it's a really worthwhile thing to do in most cases. And on top of that, doing so is going to make sure that your quarterly tax payments are as low as they can possibly be. And yes, I did say quarterly tax payments. So now the next thing you should do is click that subscribe button down below and check out this video over here where I dive deep into the quarterly tax system. Because as an influencer, you're likely going to have to pay your taxes on a quarterly basis, not just once a year. So that video is going to break down exactly how that works. Make sure you check that out, and I'll see you over there.